Today's the 9th of April 2020. My name is David Hickson, and in today's market update I'm going to be discussing whether the recent bullishness in the markets indicates that a new bull market has started or not. Before we take a look at the markets, please make sure that you have read and understood these disclaimers. I would like to start our discussion by going back to the analysis that we were looking at in my previous market update, in which I had stated that I thought it was likely that the 20-week cycle trough had formed here on the 31st of January, and I provided my reasons for that in the previous market update. Of course, if that had been a trough of the 20-week cycle, then we were witnessing a steeply accelerating bear market. As it turned out, of course, I was wrong in positioning the 20-week cycle trough over there, and the alternate analysis, interestingly, the default analysis that Sentient Trader was providing, was that the 20-week cycle trough still lay ahead of us. And so this trough that formed over here turned out not to be a trough of the 20-day cycle, but probably a trough of the 20-week cycle. So we'll take a look at that in a moment. As this bounce out of the trough on the 23rd of March unfolded, how would we have known that the analysis that we were looking at with the 20-week cycle trough at the end of January, although Sentient Trader has moved it here to the beginning of January, but in essence it's the same analysis, how would we have known that it was incorrect in terms of the placement of that trough? Well, the way in which we would have known it was by taking a look at the way in which price interacted with the FLDs. Now, there are many FLDs, but the 20-day FLD proves to be a very good and reliable one. And so as price came up to the 20-day FLD, we were, according to this analysis, expecting a trough of the 20-day cycle. And when price came up to the 20-day FLD, there was still nothing particularly unusual. As price broke above the 20-day FLD, however, that was a warning sign, or not really a warning sign, that was a sign that the magnitude of the trough was probably not only of 20-day magnitude, but was in fact probably a bigger magnitude trough, the 20-week cycle trough. So let's take a look at that analysis. And I've mentioned before in previous market update videos that I always keep a default analysis on Sentient Trader, which is an analysis that I don't affect in any way, because very often the default analysis turns out to be the correct analysis. And yet again, that seems to be the case. Here is that default analysis. I've not influenced this analysis in any way. And you can see here is the really big cycle trough, which is being marked as a trough of the 9-year cycle at the end of 2018. We've discussed this previously. Here is the 40-week cycle trough in early October of last year. And where's that 80-day cycle trough? There's a slightly strange positioning of the 80-day cycle trough. Well, maybe not. There it is over there in December. And here you can see the trough on the 23rd of March has been marked as a trough of the 20-week cycle. Now, I discussed my reasons for not expecting the cycles to stretch longer quite so quickly with the turn into a bearish market, but it seems that that has happened. And if we zoom in just a little bit and I can measure that cycle, I'd like to keep that 18-month cycle in view. There we go. So if we measure this cycle, you can see that this 20-week cycle played out at 172 days. The average length of a 20-week cycle is 136 days. So that's a 36-day long cycle. That's fairly long. It's not impossibly long by any means, but it is a fairly long cycle. And that is why I was not expecting it to expand quite so quickly. If the position of the 80-day cycle is correct, which of course it might not be, then that 80-day cycle was stretched all the way out to 104 days. Now 104 days really is quite long for an 80-day cycle. So we've seen these cycles stretching fairly dramatically. Nevertheless, this analysis really seems to be the best analysis at the moment, because the rise out of this 20-week cycle trough has been so strong. Well, the interesting thing is that the media are reporting it as this fantastically strong move, and even friends of mine who have no interest in financial markets are saying that they've noticed the headlines about the markets climbing 11%, 12%, 15%, some of them. So why is the market so bullish, considering what's going on in the world, what with the pandemic and so forth? Well, yes, of course, the move has been fairly strong, but what those media headlines don't really mention is the fact that it has followed an extremely strong downward turn. So a lot of people are asking, does this mean that we are now in a new bullish market? Is that the end of the bear? Is it all over? Well, according to this cycle analysis, the answer is very clearly no. And in my opinion, we are not seeing the start of a new bear market. The S&P 500, I think at the moment, and I'm recording this video early on the day on Thursday, it's before the US markets open, and so you can see that little bit of still upward moving price movement there at the end. That's overnight trading on Thursday morning. And so the markets have corrected, I think, about 50% now for the S&P 500. So we're looking at a 50% correction of the previous move downwards. So if this is the correct analysis, then what we are witnessing is a bounce out of this 20-week cycle. And what lies ahead of us is still this big trough here from about July into September, which is a trough of, as you can see, at least 18-month magnitude. There's the circle for the 18-month cycle trough. So an 18-month magnitude trough is a fairly big one, and of course that is the movement that I've been looking at and speaking about since about November last year, the fact that the markets are coming down into that big trough. Now I'm just zooming out again because I'd like to point out, as I have mentioned in previous market updates, that this 9-year and 54-month cycle trough phasing over here I always take with a pinch of salt. And I am more interested really in tracking the 18-month cycles. It's because of the time frame that I'm looking at. And it is quite possible that the 54-month and 9-year cycle troughs actually should be hopped over by one 18-month cycle. I've mentioned that in previous market updates, so I hope that's not too confusing. So don't be fooled into thinking, oh, well, we don't have anything to worry about because this is only an 18-month cycle trough. It's not such a big cycle trough. The danger is that we are in a market that has turned bearish. And in previous market updates, I have mentioned the magnitude of this peak, which could be a very big magnitude peak, at least a 9-year magnitude peak. Some people have suggested it's a 14-year magnitude peak, even an 18-year magnitude peak, or much longer. So I'm still of the opinion that that's a really big peak. I do not see prices getting up to that level again really soon. Of course, I could be wrong, but according to this cycle analysis, that is the really big magnitude peak that has formed, and we are looking at price coming down further. So let's take a look at how some of these cycles have played out since this trough over here at the end of 2018. Let me zoom in like that, and let's speak about this final 20-week cycle that needs to play out to take us into the big trough expected a little later this year. Okay, so let's focus on the 20-week cycles. So I'm going to draw the M shapes for the 20-week cycles. That was the first 20-week cycle following the really big cycle trough over here at the end of 2018. The next 20-week cycle was that over there, and you can see a progression from this cycle to this cycle. Here we had very bullish, here we had less bullish, which is what you would expect. Then following this 40-week cycle trough over here, we had this 20-week cycle playing out, which has of course turned horribly bearish. So now what are we expecting? If this analysis is correct, then what are we expecting for the next 20-week cycle? Well, again, there is a progression. The next 20-week cycle is expected to be more bearish. And that is really the big warning here. that the next 20-week cycle is expected to be more bearish than the previous one. In other words, this bear is not complete yet, according to this analysis. And so let's have a look at some of the details. If I zoom in here, and let's put up the 20-day FLD on this chart as well. Assuming that this analysis is correct, then the 20-week cycle trough formed over here on the 23rd of March. Price came up to the 20-day FLD and crossed over it in what would be labeled an A category interaction. A category interactions generally result in price achieving their targets, and usually following a 20-week cycle trough we would expect those targets to be exceeded. So what is that target? Well, working with a low price of, I think it was 21.81, and this crossing level over here where the median price crossed the FLD was at about 2,500. So that projects a target of 28.19. And as you can see, price has come up to 27.72 so far before the markets have opened on Thursday. And so we're not very far from the 28.19 target. The important thing, however, is that the target has not yet been reached. And given the fact that, as I've just been pointing out, this market has turned bearish, we must bear in mind that we have a bearish overtone to the market. Now, some people might be surprised to hear me say that because we've seen 3 weeks of bullishness. How can there be 3 weeks of bullishness when the markets have turned bearish? Well, the point is that the volatility in this market has increased tremendously. The down move has been really strong. That was a really big move down. And it's not very surprising that the move up that followed has also been strong because of the general excitement or the mood, the beginnings of panic that are appearing in this market. It has simply increased volatility. So despite the fact that we've seen such bullishness in the market and people are reporting 11% gains and 15% gains in terms of how much the prices have increased, nevertheless, those prices have still not yet achieved their A category target. An A category target should be achieved and surpassed. However, given the fact that this market has distinctly turned bearish, then I would actually not be surprised if the market doesn't quite achieve this target. So what do we need to do now? Let me zoom out a little and let's discuss this final 20-week cycle that needs to play out to bring us into the trough later this year. Our expectation on the basis of this cycle analysis is that we're going to see this rise over here. Then we're going to see the market coming down into this 80-day cycle trough over here. And then we're going to see the final move down into the 18-month or greater cycle magnitude that we are expecting later this year. Of course, it is possible that this cycle analysis is wrong, which is why we need to be monitoring very carefully what is happening. If we find that this bullishness persists and we are seeing a persistent bullishness, then we can again ask ourselves the question of whether a new bull has started, and we might come up with a different answer. At the moment, however, I must say that the answer to the question, has a new bull market started or not, is, according to this analysis, no. And I think that we need to be careful of the fact that the greatest part of this bearish move does still lie ahead of us. Let's take a very quick look at the composite model line just to show what this analysis is indicating is happening in terms of the way in which the cycles have influenced the markets. There is the composite model line for this analysis. You can see a peak here a little bit earlier than the actual peak in prices, which is not unusual. And here we have the trough. You can see the composite model line is indicating, because of the increased volatility recently, that we're going to see a much higher rise, but then the market is going to fall down into this trough over here. Now, I thought I would show you a completely different analysis. I've kept saying in this video, if this analysis is correct, is it possible that a new bull market has started? Yes, it is, but in my opinion, it means that we need to accept that there are some very different cycles working in this market. So I'm going to throw this out there just to play devil's advocate. I'd love to know what you think. Here is an analysis that I've quite enjoyed watching over the past few years, actually, which has a very prominent trough here in 2016. That's the last trough of what we would call the 9-year cycle. And you can see the next 18-month cycle is over here, then another 18-month cycle over here. And the recent trough at the end of March is phased, according to this analysis, as a trough of the 54-month cycle. However, this is not using Hurst's normal default nominal model. I'm using a shorter nominal model here. It's an interesting concept. It's something that I started looking at a few years ago when a Sentient Trader user suggested to me that perhaps the cycles that we're tracking in the markets are slightly different, and that instead of an 18-month cycle, we're looking at, I think, about a 14 or 15-month cycle. Instead of a 54-month cycle, we're looking at about a 40-month cycle. And you can see the recent length of these cycles over here at the bottom right-hand corner of the chart. You'll see that they are not the normal lengths that we're used to speaking about. They're all slightly shorter. It's a very interesting analysis. It's not always a very good analysis, I should point out, which is why I don't normally speak about it in these videos. But to give a slightly positive alternative, according to this analysis, the really big cycle trough that we've been looking at has formed. So if this turns out to be the correct analysis, then we are still going to get a 40-day cycle trough in early May, and we're also going to get an 80-day cycle trough in the middle of June. So there's going to be very little difference in terms of the shorter-term fluctuations. But of course, the big difference with this analysis is that the big trough has formed in the markets, and therefore the answer to the question is yes, a new bull market has started. I'm throwing it out there because I think it's an interesting idea to discuss. Is it possible that the cycles that we track in the financial markets are perhaps about 20-25% longer than they should be? Should we be looking at shorter cycles? I would love to hear what you think. What is the outlook according to this analysis? Well, let's again show the composite model line. There we go. It's showing something fairly different, obviously, because the big trough has formed. So how are we going to know which of these analyses is actually playing out? I generally avoid showing completely different analyses in this way, and the reason is because it can get a little confusing. But let me explain to you exactly how we are going to know. We are going to watch what is happening over the next 2 to 3 weeks. And here is the 20-day FLD on this analysis. Here we have our price crossing of the FLD at pretty much exactly the same level as it is on the other chart. It has not yet achieved its target. If price comes up and achieves the target and exceeds it, that's going to be the first sign that perhaps the market is the bullish alternative. Then we're going to watch as price comes down into the 40-day cycle trough. And if price comes down to the FLD, perhaps finds support there, doesn't get all the way down or doesn't achieve its target on the downside, then we do indeed need to come back and consider the possibility that the cycles that are influencing the markets are shorter than the cycles that we have been working with. I would like to point out that this is a lower probability outcome in my opinion, and we need to be cautious of the fact that the bear is still going to continue into later this year. I do hope that you found this market update interesting. Please bear in mind those disclaimers. I am not making trading advice in these videos. All I am hoping to do is to shine a light on how the cycles are influencing the markets. I would love to hear from you, whether you agree with me or disagree with me. And I hope that you are staying safe, both in terms of your health and in terms of your investments.